You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Today, I want to start out by reminding you, as I always do, that there's a website called wealthformula.com. Lots of different things to check out there, resources, things to sign up for, yada, yada, yada. So go there, wealthformula.com. Always a reminder, it's good to just know what's on the website. You might be missing out. As for today's show, I want to talk a little bit about, well, I'm going down memory lane. All right, I'm going down memory lane. So when I was a kid, my dad, I remember, deposited $1,000 in a savings account for me and also for my two older siblings at a local bank. And I'm not sure exactly why he did that, but what I do recall is that my older siblings showed me that I could go into the bank every couple of months and ask for this magical thing called interest. And I was like, interest? Basically, it was like free money. You just go in there every couple of months and they give you some free money. And I remember that I was probably about 7, 8 years old at the time. This would have been, early 80s. And a little BMX bike. I'd ride over to the local bank, and then I'd have a passbook in hand. You know, I had my own little passbook. And for those of you who remember, the passbook, it was kind of like this little passport that you had with your own bank information. And all you needed basically to make transaction was that passbook. And every time you made a deposit or withdrawal, they would put a record in there as if, again, like a passport, like where they mark where you've been and all that kind of stuff. Now, this was, again, the early 1980s. Interest rates were exceeding 15%, and I don't know exactly what my savings rate was at my bank, but I do remember coming out of that bank every couple months with some serious dough, like $20 at a time, and to celebrate, I'd cross the street, get myself 99-cent McDonald's cheeseburger, and, life was good. And listen, times have changed. No more passbooks. And I doubt that a bank would let my 8-year-old just walk in and ask for, her interest on her account. They didn't really even let her have an account really right now. In fact, they'd probably laugh at her and tell her that banks don't pay interest anymore anyway. Kid, get out of here. But wait, is that true? Or is it should be true? I mean, back in those high interest days, people were getting, you'd hear stories about people getting 10% interest from their money and living off of it, basically, Of course, we know for the last several years, really starting from the financial meltdown, those days, we've been accustomed to basically near zero interest rates. They've been really, really low for a long, long time, like a generation of people growing up and having essentially no expectations at all for any kind of interest on their deposits. Now, granted, it was great taking out loans, but not so good for deposits. Now, the thing is that now interest rates actually have risen back to levels more consistent with historical levels. And banks really ought to be paying us more interest. And you know what? They know that. But as my buddy Peter Arts, who brought all this to my attention in the first place, pointed out, these banks aren't going to go offer it to you unless you ask, right? Oh, yeah, you're right. Yeah, I suppose you could. Yeah, if you move money around. Yeah, sure. In fact, Pete, who is my old neighbor from Chicago, he knows the banking system as well as anybody I know. He's a really smart dude. Has been working in fixed income for major institutions and stuff for a very long time. He's getting over 5% on his cash sitting in the bank, right? He's over 5%. Think about that. Like, okay, you got maybe your business account, maybe you got something else, whatever. Maybe you got $1 million there. That's like 50 grand. 50 grand you're leaving on the table potentially. Anyway, simple tweaks to make you thousands of dollars per year sounded like a great reason to interview Pete for this week's Wealth Formula podcast. Now, make sure you tune into this, because if you don't, you could end up, leaving a lot of money on the table. So when we come back, my buddy Peter Arts Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is my old friend, Peter Art, who is used to be my neighbor in Chicago. Pete is a super smart guy, served as the Bank of Montreal's Global Asset Management's global head of liquidity for the last 10 years. In addition, he was also the head of U.S. private debt, taxable fixed income, and Canadian fixed income. In his role, he oversaw $50 billion in assets across Toronto, Chicago, and London, managed by a global team of portfolio managers and credit analysts. He's also served on global committees for counterparty investment and risk. Pete, good to see you, man.
Great seeing you, buddy.
So, this is an interesting way to do things, I think. Like, sometimes Pete just tells me interesting stuff, and then I just kind of keep it to myself, or else I mention it on the show as if I thought about it and ripped him off like that. So,
what do they always say? Imitation is the best form of flattery, whatever.
That's right. So instead of doing that, I'm actually going to give him credit for a lot of the for his own thinking. So, Pete, first of all, obviously you've been involved with fixed income and know probably the bond markets and all that stuff better than anybody else that I know. And I'm just curious from your perspective. And, we talked a little bit offline about, the things that you think that are happening or could happen, or what's, not predicting necessarily, but where you're seeing the conflicts within the economy. Mm-hmm. Why don't you tell us a little bit about that?
Well, I mean, there's obviously, as soon as you think that you've got something figured out, something kind of comes around and, really blasts us. Like SVB, I think, was a pretty big shock to everybody. But more or less, it's kind of like that has put an unbelievable stress in different ways, I think, on the banking system, because we're getting a lot of reports that people are obviously, there's billions and trillions of dollars on the front end, right, of the curve in cash, right? Mm-hmm. And a lot of people have moved those from the banks, whether they want the higher rates because they're going into the money market funds or the short-term mutual funds, right? Or they went because they started to panic from some of the smaller type banks, right? So the recipients been all the big banks, the Chases and the Bank of Americas. And, now they're all leaving those banks and going to the money market funds. So there's been a little bit of a buzz going around about, if you have to start making whole on those deposits as people pull out, what is the game that's involved with the banking side and how they have to, sell or take losses. I think one of the big things with banks is that they have this, this hold, portfolio that they can just hold the securities and not really book them market to market. So, as they get more punished and have to sell those things, they have to actually book those losses. So this is kind of what happened with SVB,
Second, real quick, just because, you probably know a lot more than us. So you're talking at a high level, but just explain to me, first of all, what you think. Tell us what happened with SVB. And I guess the next step is, what's the difference between Silicon Valley Bank and the larger banks where a lot of this money is migrated?
Yeah. I mean, I think you could go into all kinds of different things about the balance sheet and how it was managed and how much of their not for sale portfolio was indeed on the SVB books that they had to start tapping. And very simplistically, they loaded up their balance sheet with some, with bonds way back when rates were low, right? So when rates came up on the back end, they basically, prices go down. It's that simple. They go inverted. So they sat there for a while, but when you looked at the percentage compared to other banks, I mean, I think most banks hold under 10%. I believe that their not for sale portfolio was somewhere in the high, 70s or something, so that's what caused a lot of their pain. But more than their pain is no one's ever really looked at the diversification of a client base, right? Everyone kind of says, oh, what's the diversification in your own portfolio? Well, I mean, they had a monopoly on that tech sector.
Right.
And when they did their loans or whatever they did for their business, to bring those customers in, part of the deal was, well, we want you to be we want to be your number one bank also. So if you put X amount of deposits in, we could probably make more favorable loans for XYZ, or we'll, participate in your company going public for whatever fees or not. So, it's interesting that they did have all of their eggs in one basket. So, one runs, they all run, I guess.
That's right. That's right. And then, so, I mean, do we get the sense of security, I think, that people get from the bigger banks? Do you feel like that's warranted?
Yeah, I mean, we obviously lived through 2008, and, we all got in our vocabulary too big to fail, right?
Right.
So, I mean, the way to look at that, I think sometimes is to think of it more from a standpoint of, what will the U.S. do to back you up on that case, right? To what extent will they go in? We've seen it on all degrees. We saw them host the party to sell Bear Stearns at nothing, right? And then we saw them walk away from Lehman, or basically give an entire investment bank and a property in central Manhattan to Barclays for pennies on the dollar. So to what extent, they come in like with AIG and Goldman, I think that they've proven they'll do everything in their power. Yeah. And they obviously have a bunch of these programs right now, and we could get into that at a different time. But it's like the programs for them to take all these things off their balance sheet, put them on, loan them at 100% or $1, however you want to look at it, and pay, give them the liquidity they need. It does smell a little bit like a house of cards at some point, but it wouldn't be the first time we've seen this in the U.S. before. So
talk a little bit about I think one of the things that we talked about offline again was most people, probably including me, don't really understand interest rates that well. Mm-hmm. Tell us what we're missing.
What happens is there's three things that people understand about interest rates. One is if they have a mortgage, right? That's the first introduction. I mean, maybe when we were kids, you've got interest rate on your savings account, right? That was... and the other interest rate that we all get hit with is sales tax. So we start to understand it from that standpoint, right? And then obviously, you see it from the interest rates or the percentage that you pay for income tax, right? So that the percentages increase as you make more money. So you put all those together. Oh, and car loans too. I think that what we've seen is... we've gone for almost 12 years with no interest rates until the last year, right? So there's generations, of people that have already, two generations maybe, the tail end of one and this new one, that they don't know anything about savings rates. They
don't expect it. They don't expect them, which is what.
No, why would you? You've been getting paid nothing on your money forever, to sit in the bank. You could go and buy a 9-month CD, 2 years ago for like 40 cents. But like, when you're dealing in smaller amounts or savers, it's pennies. So people just ignored it. But now, at 5%, what you're seeing on these money market funds or these MMDA rates that the banks are paying, which are, anywhere between 4 and 5, that's real money now.
Yeah.
So, I mean, that's kind of where the interest rates start to become interesting. I mean, I think everybody should take an interest rate class in high school or college, just so at the very least they walk away and understand that what a 20% interest rate on your credit card is, right?
Yeah, for sure. Yeah. So one of the things that I thought was really interesting, and ultimately, like, I was like, wow, we got to get you on the show, is this... the type of consulting you're doing right now. And what it relates to is exactly what you just referred to, which is this idea of really not understanding interest rates. And basically the banks are like, oh, you don't even really know, do you? So I'm not going to give you what I'm actually supposed to give you, given the fact that interest rates are going up. So give me an example. Like, what are you talking about? Say somebody has $500,000 in the bank right now. I don't know. I don't even look to think about like interest in the bank giving me money, but apparently they should be.
They should be. But unfortunately, because it's gone so long, it's now your job to go fish that out.
Yeah. And that's like leaving money on the table, right? Basically. So,
Totally.
Right. So tell me what you've been doing, because this is really, I think, a really useful and pragmatic thing to do.
Well, I think what it bore from is originally, like in our fixed income group, we had what was called a capital asset management program that we built. And it was always expected that corporations' checking accounts do not earn interest. That has always been the case. People, different story. So what we would do is we figured out ways to sweep that money in and out and get them invested, basically. And I think that's what's happened now. And what I've been consulting on is looking at corporations, that have decent amounts of balances that they're sitting on, or seasonal balances. They come in, they go out, they get paid by their clients, it gets shipped out for XYZ. Well, if you look at the average balances and you look at the time horizon, you can actually, once we get, maybe a little at the end of the tunnel here with the Fed, you're going to have where you can put the money out a little bit farther and get paid more than the front end. But right now it's still kind of inverted. So you're talking, money market's going to pay around 5%, the best ones. And, where do you get that on the curve? Well, 6 months out is 5%, right? And then it goes straight down. So the question right now is kind of a holding pattern, and a lot of these corporations, they're sitting in there and they're not getting paid. So if you go into the bank and you start asking and digging around, do they have a money market platform? Who have they buddied up with? Do they have an MMDA rate? The biggest question, obviously, which was forego with the SVB incident, was the whole, what am I insured up to, right? 250 grand, right? By the FDIC. Well, the government kind of just threw that out the window.
Yeah. That was to prevent probably further runs. Yeah, right.
I mean, and they used to have these programs called cedar programs where you would go and, back in the day, I think the level was 100 grand, and they would go out and these programs would go and buy, a series of CDs across, or put them in all these different banks to make sure you were fully, protected. Well, now with what we've seen, obviously there's a certain level of protection that goes through 250, as proven by some of the larger investors and holders of those bank accounts at SVP.
Right. So this doesn't apply just to companies, though, right? I mean, you've been
no, not at all. Not at all. I mean, we've convinced a lot of people, like, get into your bank and go look at what their products are. Look at if they have money market funds. I think even when you get to a certain amount, you can actually make an argument to go into institutional shares too, and not retail shares, which, that's going to be
what does that mean? Explain what that means.
So a lot of mutual funds will have both a institutional share class and a retail share class. Simply put, it usually had to do kind of with a minimum back in the day. It used to be like 100, but a lot of times, different will require a different type of registration, whether it's a corporation. But, with a lot of the investors like you deal with and stuff like that, you've got, you've got the QIB side of it. They're qualified investment buyers. So they almost look and smell like an institution anyways. So you should be able to get those institutional share classes and pay less in fees. You're looking at money market funds would charge anywhere up to 60 to, or 45 to 65 basis points as a fee. But the institutional will charge anywhere between 18 to 22,
Right. Okay. So let's just kind of just put this in basic terms here. I'm looking at, just look through just a few business accounts and, like from our real estate syndications and stuff. And I can right away see just in a few properties, we've got probably about $2 million just sitting there just because, it's capital reserves and stuff. Mm-hmm. Right. So what you're telling me is, I mean, and these are, this is in JP Morgan Private Bank and all that kind of stuff.
I know JP Morgan for fact has an MMDA.
And what is an MMDA?
And I know that thing's paying 4 3/4, I think.
So what's an MMDA? What is that?
It's a money market deposit account.
Okay. So basically, is that just the same thing as a savings account?
Yeah, sort of. It's obviously a front end. It's got daily liquidity, so you don't have this 2 T+2, as they say, or 1, you can sell it and get it the same day. But it is an act of buying and selling. You have to go in and you got to give the instructions to do it. In some cases they'll have auto sweep, but I'd have to look a little bit deeper into.
And and then you have to pay capital gains on that and all the. Well, obviously, because you're just your interest.
It's just interest. So
it's just interest, right? So, but still, it's good now. So how for somebody who's like, for example, in this situation where you've got a couple $1 million, it's also being used and replenished and used and replenished and that kind of thing. So how practical is that for somebody who's got a business?
Absolutely. I was totally practical.
Yeah.
What we would always say back in the day when we were trying to convince corporations, and the thing is the reason why people used to drop the ball, forget low interest rates, right? They're working on their business, right? Like they built that business because they're an expert in X, Y, and Z, right? They didn't go to school for finance and everything like that from the standpoint of looking at interest rates. They're trying to build products or whatever the services they're offering. So the CFO or the treasurer is looking at the books and they're trying to manage all the expenses. It's, kind of the last thing on their mind. And the thing is that that's why we would come in there and we would do a SMA or a separately managed account for these corporations, then we would manage their cash for them. But we had people that money was changing hands every day. They had anything from payroll to paying for, accounts receivable, payables are coming in. It doesn't make a difference what it is. It's just a matter of getting it invested. And I think what we would say, and that's kind of back to my point, was don't pay other people for your liquidity. And that's what it is like, if you don't need the money, then figure out how you can get it to start working for you.
And again, just to emphasize though, when you do need to use it, it's not that difficult to,
Very easy. It's just tapping the liquidity reserves. And I think most people see that ability, like if they have a Fidelity account, they'll have it sweeping into some government fund or something like that. It's very similar.
So I know you're consulting with companies and stuff like that, but like at what level would be practical for somebody to reach out to you? I mean, if they have like an average savings just sitting there in the bank of like $500,000, is that?
Yeah, I mean, I think the first thing to do is obviously kind of look and see what you're earning, and see if the rule of thumb is how close are you trending to Fed funds, right? So we can all look that up and see it on our screen. So, if it's half, so if you're getting paid with a 2 handle or a 3 handle, you probably need to roll up your sleeves and look a little bit deeper into the bank. And see what they say right away. I mean, sometimes what I've done, is I'm looking to build up, kind of some investment guidelines for their staff, or like, a treasurer will have a bunch of people working for them, like get them in the mindset of how do I get this money to work for it? How do I set up an investment, agreement from the standpoint of, what can I return back and what are the rules and guidelines of the funds that we want? And a lot of times in these cases, in the personal side, people will go and use muni funds, right? Or tax exempt money market funds because they want to, they like the taxable yield side of it or the tax-free yield. So it's kind of looking at what you've got. And that's kind of what I've done for the corporations, is kind of come in, tell them the possibilities, get them ready for when the music stops here. Because when the music does stop and the Fed does stop their whole interest rate scenario here, you're going to get obviously everybody running to try and get that money to work out farther than overnight, right?
Yeah.
And at that point in time, are you going to be able to lock in huge windfalls? No, but you're going to be able to lock in maybe north of 5% for, inside a year, hopefully.
Yeah. And obviously that's not insignificant. I mean, I know there's people listening to this show who've got, $1 million just sitting in the bank right now. And there hasn't been a lot of opportunities. They got money back from an exit and they're just sitting on it waiting. and you could be getting maybe up to 5%.
$3,000 a month. It's probably $45,000 a year on $1 million.
Yeah. Yeah.
And then obviously multiply by whatever million you have.
Yeah. Yeah, absolutely. And is that based on, it says based on an average? Is that kind of how that works though? Like if you do have an active account that.
Yeah. What an MMDA or, one of these things, what they'll do is they'll look at your average monthly balance. So back to your point, can you go in and out? Sure. So they're just going to run a 30-day on that, and then they're going to pay you the interest on the first of the month.
Yeah. Got it. Well, tell me what else we need to know here, Pete, because I mean, this stuff is pretty foreign to me, obviously. I mean, you're like a true finance guy. What else do we need to know about, how the banks are screwing us and what we can do about it?
I mean, it's. I think they're just slow to rise. Now, you talk to anybody that runs a bank, they always would say that they always are slow to rise, and we know that. It's just that I think it's been slower from what I've seen.
Yeah.
So,
yeah.
And you do have to take matters in your own hands to go and see what the bank has to offer.
So I know you do the consulting, and again, what I understand you're saying is really, if you've got several $100,000 in the bank and you at least, and you're just sitting on it, you could be making money on it. That's the bottom line.
Yeah. I mean, well, look, per 100, if we just said it was 45 grand for $1 million, it's going to be $4,000 per 100,000. Right. So
right.
That's still real money.
Still real money. Right. For sure.
Yeah.
So, so what I'm going to do here, and just so, cause I know this is not like this is a consulting business, a private consulting business. And, I don't want you to get inundated with phone calls and emails directly. So, if anybody wants to, learn from Pete what he can potentially do for you, that was my main reason for, getting Pete on, because I think actually he could probably help a lot of us make some money it's money that we should have already. It's basically taking the money that we should have.
Yeah.
These are real numbers. And to Pete's point, again, we don't think about this because we've lived in such an environment of near zero interest rates for so long that we don't expect anything. But now, I mean, hell, we should expect something. So if you want to get in touch with Pete, just reply to any one of my Bucket Wealth Formula emails and, just ask me to forward your contact to Pete. And, you can just get in touch with him directly. It doesn't really involve me. So, well, Pete, thanks so much for being on, man. Is there anything else
no problem.
You want to mention to anybody who reaches out?
No, I mean, obviously we're living in a real interesting world right now.
Yeah.
So we've got all kinds of things going back and forth. Yeah. And how do all these interest rates affect mortgages, and how do the mortgages affect, the different housing values, obviously, as you and I have talked a lot about commercial, what's going on with the commercial, real estate, and how are these cities per se going to repair themselves, or are they, So I think it's an interesting time, but everybody buckle down. Yeah.
In the meantime, make some money off your bank.
Well, I mean, just get paid for the use of your money,
Right.
I think if you really look at it, some of the theories are that if everything that's happened with the rates and the ability or inability now for the banks to loan out that money, whether it's because of high rates and people don't want to pay for it, or just the demand is down, that in itself is another tick of that the Fed wants to see to stop raising rates. That's another component that they want to see as they try to cool this thing down. I think that obviously, one of the main things to get into a recession, you have to have a decent amount of job loss, right? That's kind of the key. And we're starting to see it. Obviously we've got a lot of, what did we have last in Chicago here? They're closing down half the Walmarts, so, obviously all the Bed Bath and Beyonds are gone, but like you
think you would need the Walmarts.
Well, you would, but according to Walmart, they've never made any money in Chicago. And I think it's not necessarily because of the economy. It's because of theft.
Yeah.
It's really the reason. So anyways, it doesn't make a difference where the job changes come from as long as they start to affect those statistics at the Fed. So we can either hurry up and get to a recession and get through it even quicker.
Anyway, yeah. Well, Pete, thanks so much for being on Wealth Formula Podcast. Again, if anybody wants to reach out to Pete about this whole getting paid by your bank thing, shoot me an email, reply to any one of my emails, and I'll forward your contact information to Pete. Thanks, man. It was good talking to you.
Yeah, good seeing you,
on the
bud.
big screen here. Okay. We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. And it's nice to have these little, we don't always have to talk to authors and macro guys. I mean, just talking to smart banking, smart financial guys who do this on a day-to-day in the trenches, you get some really good information like Pete just gave us. And just so you know, I'm hiring Pete myself. I'm having him look at all of our business accounts, but I suspect, with all of these different business accounts and real estate accounts and stuff like that, we can probably do a pretty good job of potentially making a few bucks for our investors while we have money sitting in the bank. So I am going to contact him directly. And the other thing is, Pete is not looking at people who are, got millions of dollars or companies of millions of dollars. Give him a try. I think it's definitely worth it. When times are good, it's easy. You could just sit back. But when times are like tough, like now, and there's not a lot to invest in and all that kind of stuff, you really have to, like tighten up the ship and make sure you're not either hemorrhaging or losing possible sources of cash that you don't need to. And right now, the bank, for the most part, and I know this is the case with mine because I'm definitely not getting 5% on deposits. I know that they owe me money, so I'm going to do something about it, and hopefully you do too. But that's it for me this week on Wealth Formula Podcast. Hope you enjoyed the show. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.